In 2008, one bond ETF rallied almost 34%, another rallied 18%, and somewhere between those two was the bond fund your 401k probably holds, the one that rallied around 8%. Three different funds, all called bonds, all in the same year, completely different outcomes. Most investors have no idea which one they actually own, and that is not their fault. The whole system is designed so you don't have to know. Back in 2022, my dad got an inheritance. We talked about what to do with it, and I gave him the same advice almost everyone gives about bonds. That's the conservative move. Bonds are the safe sleeve. It'll hold steady while you figure things out. He handed it to a financial advising company and they put a chunk of it into bonds. My dad thought he was playing it safe. That year, the bond sleeve fell enough that he noticed. Real money. My dad got upset and he pulled it out. At the time, honestly, I was sitting there confused too. I was sitting there thinking, wait, don't bonds just pay you a yield? Most people picture bonds like a savings account. You deposit money, you earn interest, your balance stays where it was. That's almost the opposite of how a bond ETF actually works. Your principal can absolutely go down while you're collecting the yield, and in 2022 it went down by a lot. By the end of this video, you'll know every major bond fund investors own, what's inside each one, how much it can move, when to own it, and when to rotate out. You'll know more about bonds than most retail investors, probably more than a lot of people selling them. My dad's money didn't lose value because something went wrong. It lost value because we didn't understand what he bought. And I'm putting myself in that sentence because I didn't get it either. I was telling him bonds were safe because that's what everybody told me bonds were. Take BND. That's Vanguard's total bond market ETF. It's the single most popular bond fund in America. It's probably the fund in my dad's account, though I never saw the statement, and it's almost certainly a chunk of your bond sleeve in your 401k. In 2022, BND's yield ran around 2.5%. That's what the fund paid out in interest. If you held $100,000 in BND for the year, you collected roughly $2,500 in payments over 12 months. That's the yield. That's what everyone sees on the Vanguard website. But here's what most people miss. The NAV, which is the actual market price of the fund, dropped almost 15% that year. You collected your $2,500 in interest and your $100,000 in principal turned into about $85,000. Total return for the year came in around negative 13%. The yield did its job. The yield paid out exactly what it said it would. The NAV did something nobody warned them about. People hear that and their first question is always, well, the yield went up too, right? Yes, the fund's current yield did rise in 2022 because new bonds coming into the portfolio were paying 4 or 5%. But the bonds already in the fund, the ones you were already owning, they were locked in at lower rates. Nobody wants to buy a 2% bond when they can buy a new 5% bond. The market price of the old bond drops until the math works out that buying the old bond at a discount gives you roughly the same yield as the new one. That's the yield trap. You see the yield, you think the yield is your return, but your return is yield plus NAV change. And in 2022, the NAV change was bigger than 5 or 6 years of yield combined. Now here's a fair question. Some of you are already asking, if I don't plan to sell, does the NAV even matter? Well, that's a good question, and the answer depends on what you actually own. If you own an individual bond and you plan to hold it to maturity, NAV doesn't really matter to your cash flow. You collect interest for the life of the bond, and at maturity, you get your principal back. The middle wiggle doesn't even affect your outcome. But almost nobody owns individual bonds. Most people own bond ETFs. A bond ETF never matures, not ever. It's always rolling. Old bonds get sold, new bonds get bought, the fund just keeps going. There's no end date. There's no just hold it until it recovers. When you want your money out, you sell it whatever the NAV is that day. That matters even more for retirees. If you're drawing income from a bond ETF, every withdrawal is a share sale at whatever the NAV is at that moment. A retiree drawing 4% from BND in 2022 wasn't just watching paper losses. They were locking them in, one monthly withdrawal at a time. That's sequence of returns risk, and that's exactly what my next video is about. Before we walk through every bond fund you need to know about, the mechanics have to be straight. If you don't understand what's inside a bond ETF, the rest of this video is going to sound like a math class. A bond is a loan. You lend somebody money. They pay you interest along the way. At some point in the future, they give you the principal back. That's the whole thing. When you buy a single bond, say a 10-year treasury, you get your principal back in 10 years. You collect interest for a decade. If the bond's market price jumps around during those 10 years, you don't care. You're holding it to maturity. You're getting back your $10,000. A bond ETF is different. It holds hundreds or thousands of bonds, and it's constantly buying new ones and selling old ones to keep the duration consistent. There's no maturity date. The fund just keeps going. When you sell your shares, you sell them at whatever the NAV is that day. That's the first thing my dad didn't understand. The ETF wrapper makes bonds easy to buy and easy to sell, but it takes away the one guarantee that individual bonds give you, which is that if you wait long enough, you will get your money back. All of that boils down to one variable. That variable is duration. Duration is the single most important word in bonds. Almost nobody who owns bonds can tell you what it means. Technically, duration is the weighted average time until you get your money back, including all the interest payments along the way. Practically, it's much simpler than that. Duration tells you how much a bond's price will move when interest rates move. A rule of thumb works like this. A 1% change in interest rates equals roughly a duration percent change in the bond's price. Duration of 2, a 1% rate moves translates to about 2% swing. If it's a duration of 7, it's about 7%, and a duration of 17, that's about a 17% swing. That last number is the one that blows people's minds. A 1% rate move, which is one of those headlines that goes by in a week and nobody really notices, can move a long duration bond fund by 17% in either direction. That's leverage. Most people who own long duration bonds have no idea they're on that kind of leverage. Here's the direction rule. When interest rates go up, bond prices go down. When rates go down, bond prices go up. That's the inverse relationship. A new bond paying 5% makes an old bond paying 2% less attractive, and the old bond's price falls. A new bond paying 2% makes an old bond paying 5% more attractive, and the old bond's price rises. Put those two rules together and 2022 makes sense for the first time. The Fed raised rates from basically 0 to about 4.5% in 9 months. That was one of the fastest rate hike cycles in modern history. Here's what happened to bonds in 2022. A short duration fund like SHY, which holds 1 to 3 year treasuries, it lost about 4%. A medium duration fund like AGG, which is the total bond market, lost about 13%. A long duration fund, TLT, which holds 20 plus year treasuries, lost around 31%. That's 3 different funds in the same country during the same year with the same rate hikes. One of them lost a month of grocery money, one lost a year of retirement income, and one lost a third of its value. The rule of thumb isn't perfect for giant rate moves because bond yields offset some of the price loss and duration actually shortens as rates rise. But the direction is right. Longer duration equals bigger swings, both directions, always. And for anybody still thinking that this is theoretical, here's what 17 years of duration actually looks like in real life. The iShares 20 plus year Treasury Bond ETF, TLT, 5 years of holding the most conservative government bond you can buy, down 38%. That isn't a crypto chart. That isn't a tech stock. That's long duration U.S. Treasuries. And if you were a retiree using this as your safe sleeve, you spent the last 5 years watching almost 40% of your safe money evaporate while the financial industry kept telling you long bonds are conservative. That's duration. That's the dial cranked all the way up. Now, before we walk the lineup, here's something worth sitting with for a second. Most investors put real work into the equity side of their portfolio. They'll spend a Saturday afternoon comparing VOO and IVV. They'll read 3 articles on whether QQQ beats SPY over the rolling 10-year period. They know the expense ratio of every fund they own down to the basis point. They've got opinions on covered calls, on growth versus value, on small cap versus large cap, on whether international is worth the tracking error. Then you ask them, what's in your bond sleeve? Bonds? That's it. That's the whole answer. The same person who can explain the expense ratio difference between 2 nearly identical S&P 500 funds has done 0 research on what the words U.S. Aggregate Bond Index actually mean, and that's the fund holding 40% of their fixed income exposure. Bonds are probably the least understood part of the market for the average investor. Not because bonds are hard, because nobody bothers. Equities feel like the exciting part, and bonds feel like the set it and forget it part. So people just set it and forget it without ever knowing what they set. That's the gap this chapter closes. You don't have to become a bond expert. You just have to put the same level of attention on this side of the portfolio that you've already been putting on the other side. Now let's walk through the funds themselves. I'm going to show you 8 as the teaching examples. These are the ones you'll see most often in portfolios, in your 401k plans and advice articles. There are dozens of other bond ETFs with different tickers that do essentially the same thing. The ticker isn't the point, the exposure is the point. And once you understand the 8 I'm showing you, you can recognize any bond fund you encounter, walking from shortest duration to longest. First fund, SGOV iShares 0 to 3 month Treasury Bond ETF. Look at this chart. That's SGOV for the last year. The entire y-axis range is less than $1 on a $100 fund. Every slow rise is interest accruing daily. Every little drop is a dividend payment. The fund isn't investing, it's just earning interest. Duration is essentially zero. The 30-day SEC yield runs around 3.55% today, and that's already down from nearly 5% about a year ago as the Fed has been cutting. The NAV basically doesn't move. The biggest drop in SGOV history was 0.1%. You don't own this for returns, you own it because it pays more than a savings account and you can sell it in an hour. SGOV isn't really a bond fund, it's a parking spot. You own it when you think rates are going to keep climbing or stay elevated, and you want your money earning something while you wait. Which brings us to our second fund, SHY, iShares 1 to 3 year Treasury Bond ETF. A small step up the duration scale from SGOV, duration under 2, yield roughly similar. You pick up a little NAV sensitivity for a small pickup in yield. In 2022, SHY lost about 4%, which is meaningful but not catastrophic. In 2008, it rallied around 6%. Smaller swings in both directions because duration is small. This is where a lot of conservative investors park money when they don't want stock exposure but need something with a little more yield than cash. On to the third fund, IEF iShares 7 to 10 year Treasury Bond ETF. Now we're getting into real duration. IEF holds treasuries that mature between 7 and 10 years out. Duration about 7.5. This is the fund that rallied 18% in 2008 when the Fed slashed rates from over 5% down to 0. It's also the fund that lost around 15% in 2022 when the Fed went the other direction. Same fund with the same treasuries, but at completely different years because rates moved the other way. IEF is the classic stock market crash hedge. When stocks are getting crushed, the Fed usually cuts rates and IEF usually rallies. That's the relationship people are pointing at when you say that bonds protect you. It was true in 2008. It was true again in March of 2020. It wasn't true in 2022 because rates went the other way. Fourth and fifth fund, AGG and BND. These are grouped together because they're essentially the same product from two different issuers. AGG is iShares Core U.S. Aggregate Bond ETF. BND is Vanguard Total Bond Market ETF. These two are probably the most important bond funds in America, and I'll bet money one of them is inside your 401k right now. Pull up the statement when you're done with this video and check it. Every major target date fund uses AGG or BND as its bond sleeve. The Bogleheads 3-fund portfolio uses BND. Most 401k plan defaults use one of the two. Roughly 40% of all U.S. bond ETF assets live in these two funds. When people say I own bonds, they're almost always talking about one of these. Look at the chart. This is AGG going back to 2003 when the fund launched. Two moments matter. The wobble on the left, that's 2008. The fund dipped during the year as the credit crisis unfolded, then rallied back up to finish around 8%. Now look at the right side of the chart. That cliff in 2022. That's the same fund, same kind of bonds inside, but down 13%. And here we are several years later, AGG still hasn't fully recovered. The most popular bond ETF in America is still trading below where it was 5 years ago. One thing those numbers don't capture, plus 8% in 2008 and minus 13% in 2022, are calendar year totals. The actual path in sight each year was rougher. Mid-2008, AGG was down around 7% before the Fed cut rally pulled it back. In 2022, AGG fell as much as 15% from peak before stabilizing by year end. If you panicked mid-2022 and pulled out, you weren't locking in negative 13. You were locking in something closer to negative 15%. Year-end returns are what the book shows. The path is what people actually live through. That's exactly what happened to my dad. Now, duration for these funds is about 6, which puts them between SHY and IEF. Here's where they get different from everything else we've covered. AGG and BND, they don't just hold treasuries. They hold a mix, roughly 40% treasuries, 25% corporate bonds, 25% mortgage-backed securities, and a little bit of other stuff. Thousands of individual bonds inside each fund. That mix is why these are called total bond market funds. They're diversified across the entire investment-grade bond universe. Most other bond ETFs we're walking through hold just one type of bond. AGG and BND, they hold all of them. You see the pattern. When rates fall, bonds win. When rates rise, bonds lose. Duration tells you how much. All right, on to the sixth fund, LQD, iShares Investment Grade Corporate Bond ETF. LQD is corporate bonds, investment grade corporate bonds, specifically, which means big blue chip companies like Apple, Microsoft, JP Morgan. The companies that probably aren't going to default, probably. The duration is a little over 8. Yield runs a bit higher than treasuries because you're taking on credit risk. If one of the companies inside the fund goes bankrupt, you lose out on that piece. Treasuries can't do that, at least not in any real scenario. Look at 2008. LQD was essentially flat, a tiny loss on the year. That surprises people because 2008 was a rally year for treasuries, but corporate bonds got hammered by credit concerns at the exact moment treasuries were getting a flight to safety bid. The two forces canceled each other out. LQD is really two exposures in one fund. Rate risk, which is duration, and credit risk, which is how healthy the companies inside the fund actually are. That's why it behaves differently from IEF, even though the durations are close. On to the seventh fund, TLT, iShares 20-plus year Treasury Bond ETF. TLT is the extreme end of the Treasury spectrum. 20-plus year Treasuries, duration around 17. This is the fund that rallied almost 34% in 2008 and dropped around 31% in 2022. It's the same fund with 2 different years with 2 completely different outcomes. TLT is what you own when you want a maximum bang for your bond buck during a stock crash. If rates drop a full percentage point, you're up around 17%. If rates drop 2 points, you're up almost 35%, which is exactly what happened through 2008. When rates go the other way, TLT is brutal. 2022 was the worst year for long treasuries in a generation. The entire reason is duration. The dial was cranked all the way up and it cut both ways. This is why I don't hold TLT in a retirement bond sleeve. When the bond sleeve's job is not to crash when stocks are crashing, taking on 17 years of duration is taking a bet that rates are going to cooperate. Sometimes they do, sometimes they don't. Sometimes they don't cost TLT holders a third of their money in a single year. Eighth fund. This one's a different animal, and it's the one most likely to get misunderstood in the retiree context, so let's take our time with it. TIP, iShares TIPS Bond ETF. TIPS stands for Treasury Inflated Protected Securities. TIPS works differently from every other bond on this list. The principle itself, it adjusts with inflation. If CPI goes up 3% in a year, the bond's principal grows 3%. You collect interest on the adjusted principal, which means your total return is real yield plus inflation. Duration on a TIP is around 6.5, which is similar to AGG. Behavior is totally different. Because the principal adjusts, TIPS are built to protect you in inflationary environments. Here's the catch, and this is where a lot of retirees still get burned. Rising rates still hurt TIPS through the duration channel, and 2022 had both high inflation and rising rates at the same time. TIP lost about 12% in 2022, even though inflation was doing exactly what TIPS are designed for. The inflation adjustment was real, the rate damage was bigger. Net result, the inflation hedge underperformed inflation by roughly 20 percentage points in the worst inflation in 40 years. If a retiree bought TIP in early 2022 thinking they were hedging inflation, they got hit twice. Inflation eroded their buying power, and the fund they bought to protect against inflation lost 12%. That's the opposite of what they were sold. Here's the real rule on TIPS. They protect against unexpected inflation. The word unexpected is doing all the work here. If the market is already pricing in 5% inflation and inflation comes in at 5%, TIPS do fine, but they don't outperform regular treasuries. TIPS only help when inflation comes in higher than what the market was already expecting. That's a narrower use case than most people expect. I don't hold TIPS in my own portfolio, not because I don't believe inflation is real, because I found index fund equity exposure has historically been a better long-term inflation hedge than TIPS. TIPS are a narrow instrument for a specific scenario. For most long-term investors building a bond sleeve, I think duration-matched treasuries do the job better and cleaner. Last fund in the lineup, and this one is the one that breaks the rules. HYG, iShares iBoxx High Yield Corporate Bond ETF, also known as junk bonds. HYG holds below investment grade corporate bonds, companies that aren't blue chips, companies that might actually default. The yield is high, usually 7% or more because the risk is high. Duration is low, around 3.5 because junk bonds tend to have shorter maturities and can be called back early. On paper, low duration should mean low volatility. Look at the numbers. In 2008, HYG lost almost 18%. That isn't a bond year, that's a stock year, because when the economy collapses, junk bond issuers are the first to default, and investors dump junk bonds fast. 2008 was stocks down 37%, HYG was down 18%. That isn't a bond sleeve, that's a stock sleeve and a bond wrapper. The takeaway on HYG is simple. It isn't defensive. If you own HYG thinking you own bonds, you're going to get surprised the next time stocks crash. One more thing before moving on. Every fund I just named is an iShares product. iShares doesn't have a monopoly. If you're a Vanguard person or a Schwab person or a Fidelity person, you own the same exposure under a different ticker. Pick whatever your broker carries at the lowest cost. The exposure is what matters, not the ticker. When someone tells you they own a bond fund, the right question isn't which company made it, it's what kind of bonds are inside, what's the duration, and what job is it supposed to do. That's the difference between someone who owns bonds and someone who understands bonds. A couple of other funds worth knowing by name, even though we're not dedicating slides to them. MUB is municipal bonds. That's tax advantage yield if you hold them in a taxable account and you're in a high bracket. BNDX is international bonds. It shows up in Boglehead's portfolios. If you see those names in the comments below, now you know what they are. 8 different funds over 2 different years. Here's the scoreboard. When rates fell in 2008, every duration treasury fund rallied, and the longer the duration, the bigger the rally. When rates rose in 2022, every duration treasury fund lost, and the longer the duration, the bigger the loss. Credit risk magnified the losses on the corporate side. Junk bonds followed stocks because junk bonds aren't really bonds. Same funds, opposite rate regimes, opposite outcomes. That's the dial, that's the whole game. All right, one more concept worth understanding because this is the signal that ties everything together. The yield curve is a chart of interest rates across maturities. Short rates on one end, 30-year on the other. The line connecting them is called the yield curve. In a normal economy, the line slopes up. You get paid more to lend for longer because you're taking on more uncertainty. Here's the curve today. Short rates around 3.7%, 10-year around 4.4%, 30-year just under 5%. That's a normal upward sloping curve. The bond market is telling you the rate cycle has basically normalized after the 2022 shock. When the line slopes down, that's an inverted curve. Short rates higher than longer rates. That's the market signaling rate cuts are coming. Here's an example from July 2023. 3-month treasuries were paying 5.45%. 10-year paying 3.88%. Short rates were higher than long rates. Historically, an inverted curve has preceded almost every recession in the last 50 years. Now here's the part most retail investors don't think about. Bonds work like stocks in one important way. The market is always forward-looking. If everyone knows the Fed is about to cut, that expectation is already priced into today's long bond prices. You can't just say rates are coming down, I'll buy TLT and cash in. The professionals already did that yesterday. What actually moves bond prices is the surprise, the gaps between what happens and what the market expected. If the Fed cuts 4 times when the market expected 4, long bonds don't really rally. The rally already happened in the months before, as expectations formed. If the Fed cuts 6 times when the market expected 4 times, then long bonds rally on the difference. You're not going to outsmart the bond market, but you don't need to. You just need to recognize where you are in the rate cycle. When rates are at 0, the only direction is up or sideways. Holding long duration bonds in that setup is taking real downside for almost no upside. When the rates are at the top of the cycle and inflation is cooling, the math flips. Real upside, limited downside. That's not market timing, that's just reading the room. Which leads to the rotation rule, and the curve we just looked at is how you read it. When you see an inverted or flat curve, short rates higher than long rates, or right next to each other, the market is telling you cuts are coming. You want short duration, think SGOV or SHI. Less NAV damage if rates take their time, and as bonds roll inside the fund, you capture whatever yield is available. You collect the yield and you wait. When you see a normal curve like the one we looked at a minute ago, stable to slightly falling environment, middle duration works, AGG, BND, or IEF. Decent yield, no heroics, no big bets in either way. So here's what I do, at least quarterly or whenever the Fed makes an unexpected move or something flashes in the news cycle. I pull up the Treasury yield curve. If the curve looks normal, I'm in IEF. AGG or BND would work just as well. If the curve is inverted or flat, I rotate to SGOV. I collect the yield, wait it out, and reassess at the next check. That's the whole rule. It's not complicated. I'm not trying to outsmart the bond market. I'm just letting the curve tell me where we are in the cycle and matching my duration to it. One quick note, I'm doing this in a tax-advantaged account. SGOV and short duration funds barely move on price, so rotating in and out of these isn't a tax event in any meaningful way. But if you're rotating in or out of medium or long duration funds in a taxable account, expect tax implications. Bonds belong in tax advantage space when you can swing it. You don't have to do exactly what I do, but now that you understand duration, you have what you need to make these decisions for yourself. In the next video, we're going to follow a retiree who bought AGG and SPY in January 2000. Ran a classic 60-40 portfolio and then started drawing on it for 26 years. Through the dot-com bust, 2008, the lost decade, and 2022. Every brutal moment. You'll see exactly how the bond sleeve performed when it actually mattered, and whether the 4% rule held up through one of the worst sequence of returns in modern history. It's one of the most important retirement videos on this channel. Now that you know what bonds actually are, you'll understand exactly what you're looking at. So apply what you just learned. Next time you're trying to figure out what to do with your bonds, pull up the yield curve. Remember what a normal curve and an inverted curve look like. Let that drive your decision. All right, drop a comment. What's the bond fund in your 401k? Go look at the statement, come back and tell me. I want to see how many of you are holding some version of the aggregate bond index without knowing it. If this changed how you think about bonds, hit the like button. And if you want more real data and honest explanations like this one, subscribe. Stay disciplined, stay patient, and I'll see you on the next flight.